Welcome back, everybody, to the Investors Roundtable. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft, BOBBYKKRAFT. And we have our OGs. The OGs are joining us for the panel today to talk a little. We're getting sassy today. I figured that was a nice title, right, guys? We're getting sassy. But joining us today, we got Stephen Kiel from Arquitos Capital. What's up, Stephen?
Hey, Bobby. Well, clearly the dad jokes are coming in now at this point in the podcast.
Yeah, I didn't want to wait. I figured we'd hit the people with what they want immediately, which was just bad dad jokes, Yeah. And then we got Kevin Shea at The Good Prick on Twitter. And by the way, as of recording, we're at 455. We need to get Kevin to 500. All right. Go follow him. He's a high quality follow. We're not just doing this to try and get an award for our own what's the clout or anything like that. Like, get Kevin to 500. All right, Kevin, what's going on?
Sitting in the snowstorm up here in the coast of Maine, enjoying the whiteness and trying to settle in. So we'll see what's going to happen.
Can you guys tell me what? So snow it's that white stuff that's
thing behind you, Bobby. It's on the tops of the mountains behind you. Turn around. Yeah, there it is. See, that's snow.
That's snow. I thought that this was a painting. That like sometimes people put the white thing for like texture. A little juxtaposition. I didn't realize that was actually, cold and it was a thing, right?
As you're wearing a T-shirt, basically, and this is why I tried to wear the fluffy wool coat here to honor the 6 inches that just dropped.
I got fleece on.
Yeah, I was gonna say I didn't get the memo because I'm still trying to understand this concept of it's snow, right? Okay.
Well, I think that's the stock, right? I mean, we're getting into the SaaS discussion today, so
yeah,
I think snow is somewhat related. And ironically enough, the original incarnation of the ticker Snow was probably my best investment ever. It was the old Intra-West Resorts. The ski company from 2014, 15, 16 got bought out in early 17, which then allowed the Snow ticker to be available for the latest incarnation, which I think is more on the line of what we're talking about today. Although I still don't fully understand what Snow does. Maybe Kevin can explain it. The company.
I have no idea.
Well, that's all, folks.
That's our show today, Kevin. You know what? That's a good way to get hashtag snow. Hashtag snow. That'll get at least another 5.
We got dad jokes and snow related items with no context
at all.
It's good stuff.
I was gonna say, Stephen, that was a perfect transition into SaaS and what we're talking about.
I tried.
That was pretty. No, you steered me. Because I could have kept going on my snow gig. So that was a good producer steer. But
yeah.
I figured we would, we both said offline, we're relying heavily on Kevin and his expertise, having sat on as a board of director on a couple SaaS companies. So, we could do probably, I don't even know. We could do countless hours talking about SaaS because it's just so far reaching and I'd say still even arguably in the early innings. With where we can go from here, because as technology improves, as we continue to move forward, new SaaS type businesses and models could be invented. But where we're at currently, I mean, Kevin, kick us off. Tell people what they want to know. What do we mean by a SaaS business model, and where are we at?
Well, the simplest way to describe SaaS models is it's a business dependent upon recurring revenues. Typically by some sort of sign-up subscription model. However, there are other means as well. So again, it's dependent almost exclusively on recurring revenue and the buildup of recurring revenue over time as the number of subscribers increases and the number of users increases. I think that's what comes down. The development of a SaaS company is a bit interesting because you have to put a lot of cash in up front. You put a lot of money in up front with the expectation of getting a very long-term reward out the back. So it's a business model that is far different than many other business models where you're putting in quite a bit of research money, CapEx money, et cetera, and you're building the business and hoping to have immediate returns on sales and things of that type. The long-term value of any SaaS company is the fact that you have a very stable and repeatable and reliable source of income from either the subscribers or from the types of users that you have pulled in, maybe corporate. The other thing that one has to be careful of when doing things like valuation on SaaS businesses is you have to be aware that the business model between the B2C companies and the B2B companies is far different. All right. So the company that I was with, for example, was in the B2B business, and the sales was to corner office executives and mid-level managers who wanted to rely upon a software application that literally could have been legacy, but the whole product was converted into a SaaS business and really kind of being distributed in that fashion. So again, what you're doing is that you're oftentimes selling software, and this is again B2B. You're selling software that otherwise might have been a CapEx purchase, and now it's an OpEx purchase. That's a big difference for many companies. And it drives the decision making down into the middle of the management of companies, because again, the choice is on operating a budget where you're spending $1,000 a month rather than a CapEx budget where you're spending $2 million of an upfront purchase. So again, that's kind of the simplest form of B2B SaaS. I think many people are familiar with the B2C, where you're purchasing some sort of service from a provider, and that service is costing you X dollars a month. That's the standard, simplest way to look at it. The valuations go all over the place. Again, you can't compare a B2C company to a B2B company for valuation. They're just completely different. They also range from companies that they even call Salesforce, which I don't own. They call Salesforce a B2B SaaS company. All right, so it's getting to the point where everybody's kind of being one. It makes it easier. But what happens in valuation, you get valued oftentimes against those big companies. Okay, and it's funny because some valuations of the company I was with, which is a MicroCap company, we were literally compared to in a comp to Salesforce and a couple of others. Workday, I believe. So the way they value is also kind of screwy. Okay, but the interesting thing about the SaaS businesses and how the valuation works, there's a tremendous dependency upon minimizing what's called churn. Okay, and churn is the loss of subscribers over time. So that a SaaS business, if you want to generate a high valuation, you have to have a very, very small churn, or you have a positive churn. You have a positive churn, which means you're actually increasing the number of people rather than decreasing. So the variables that play into how to value a SaaS company can be all over the place. And when you go in and look, there's a ton of research that's been done by analysts and others trying to develop means of being able to come up with a model for valuing SaaS companies. They are all over the place, and they go through any number of different means, from DCF to EBITDA based on valuation, on sales, and everything else. They go all over the place. So there isn't anything that's consistent that I can see from that model. Maybe there is on much larger businesses where there's a bit more stability in the way in which the income is derived. Okay, so I think that what comes down to is that there's a high variability in the way it's being assessed. There's a high variability between B2C and B2B. So the valuations can look to be a little bit screwball. And even when I was looking at this whole thing, the way in which analysts valued SaaS companies, particularly the ones the scale that I was involved in, changed in 2 years. They went from something like 7 to 8x to 4 to 5x sales. which is probably the easiest way of being able to value it. So it's really, it's even though it's still variable and still changing as the SaaS model changes and as people really begin to try to figure out whether or not there's a particular model that is applicable. And again, that's kind of like the general basis of it. One can go on and on. I mean, one can read a ton about this stuff if you really wanted to. But I think that's probably a brief, long explanation.
Yeah. Do you think the variability in kind of valuations across these different types of companies, forget about B2B and B2C, but just companies within each sub, do you think that variability comes from judgments from analysts based on what should be adjusted to be capitalized and what don't, like the customer acquisition cost and the judgment of how sticky those customers are? Do you think these judgments are what cause these differences in valuations, which is essentially is how good do they tell the story?
That's great. I mean, one of the things you just mentioned was the cost of acquisition. And cost of acquisition plays into the algorithm that most people use. If the cost of acquisition is, let's say, just generally high, and the loss of a subscriber against that cost of acquisition is high as well. So if you say it costs you, let's just make up a number. Say it costs you $260 to get an acquisition for a subscriber, and that customer is going to stay with you for 2 years as minimum. However, the person leaves in 8 months and has only spent $80. Okay, so you basically have in that case you have a loss for all practical purposes, to 260 minus the 280. So the cost of acquisition versus the cost of the annual return and annual recurring revenue, ARR, which is the dominant factor, or monthly RR, are the ways in which people evaluate these things, and literally through an algorithm. You talked about capitalization. I think you said capitalization. Is that what you were talking about, Stephen?
Yeah, when you think about traditional businesses and how you capitalize, basically the accounting rules allow for easier analysis from traditional businesses. And so they don't reflect well. The accounting rules make it more difficult to value some of these SaaS businesses, I think. So how do you adjust for that?
Yeah, I'm not quite sure. I'm not an accountant, but one of the things I can mention is that there are variations in that. Is that I can really only talk to the business side, because I think the consumer side is even more straightforward. But the business side, the accounting practices are kind of upset by the way in which one company and the other company wants to do the contract. One company may wish to pay you up front for the full year and then annualize the payment over the month. So you end up with a deferred payment, okay, which changes the accounting rules from standpoint of like legacy systems where you account for all of the revenue off that sale at the very, very beginning. Say you sold a legacy product for $1 million, you account for that at $1 million immediately. But now say you had $1 million in SaaS commitment or contract, but the company has said, I'm going to give you the money now, but I want to, but the accounting processes and the means of doing it will advise that the $1 million has been identified and contracted for, but it's all deferred revenue, deferred payments, not deferred, deferred revenue. So they basically, so you are in the situation where the accounting is a little bit off normal.
Yeah, more for I hear you there, and in fact, the company that I'm the chair of, we have a legacy internet business where we have to do that exact same type of accounting, where sometimes there's payments 1 year, someone will pay for an entire year, but it's a monthly. Others pay on a monthly service, and it's some interesting ways to show that, and you want to be obviously as transparent and to your investors as possible. And I think the accounting rules generally allow for some clarity there. But on the acquisition side, right, how much money are you spending as a company to acquire various customers, and the stickiness of that and it sort of can be a loss leader situation. That's where I think people like me struggle, other investors struggle. And we say, well, hey, this company is trading at, 20 times revenue or something. How can that be justified? Right. Well, maybe there's not a lot of revenue, right? Or maybe, you have to make these certain adjustments because whatever money is being spent, is to acquire a customer that could be around for 20 years. And that makes it tough. And it shows sometimes these really crazy valuations that the company ends up growing into.
Right. I think that the reason why is because you're futuring not 3 to 4 years, but 7 to 8 to 9 to 10 years, possibly in these SaaS models. So they get a little bit, again, screwball because they're out there. And if you really want to see how a company could grow into those valuations, it has to do with their algorithms of growth. So let's sit down and say that they have 1,000 customers this month, and it's growing at some normal rate, like 1,200 the following month, 1,400. So somebody will begin to do some projections, and also they do it based upon, dollars of marketing money spent to sales delivered. So again, there are some simple and more complex algorithms that can be used for model development, in which the company is projecting to the investors that this is what we're going to do. Okay. The question is that what happens when you don't do it? What happens when the churn exceeds your expectations, or the churn doesn't happen, and that you're struggling to keep subscribers? I'm familiar with a company that was doing. They converted it's called electronic logging. It's for drivers. Any driver who drives a tractor trailer has to log his hours according to some of the government regulations that are out there. And they install these devices inside of trucks, a little tracker, a little device that counts the number of hours for all practical purposes. And they went from selling the individual device to selling the individual device as a service. Okay, and this company, what they found was that they could sell them, but they couldn't manage the subscription because it was highly competitive, and it's still, that business is highly competitive, the logging devices. So even though this company showed growth and showed promise and things of that type, I think they got caught in the tailwind of too many competitors offering the same type of product. So again, if you have something that's, again, we all know this, but if you have something that's quite unique and not very competitive, then you can steal the market. But however, if you have something else that's not as unique, then it's really a crapshoot at that point in time.
So I want to kind of take us back just holistically thinking about SaaS. And I know we're kind of getting in the weeds a little bit here, but really what we're talking about is, especially from an investor's perspective, what makes this attractive is that you're talking about an asset-light business, that there's not a ton of CapEx, and you're also, in some respects, as we start to get into a little bit here, you can kind of project out what maybe future earnings might be. In some respects, of course, you have to figure out what the churn rate is and, what their cost of acquisition could be. But at least modeling it out, it makes it somewhat easier. I don't know necessarily than any other kind of business model, but at least there's some kind of formula in place so that you can kind of better understand what's happening. But it varies from industry to industry. And what's interesting that I've seen, especially in microcaps, I've definitely a few companies that I know, Kevin, off the top of my head, is that it seems that this model has really been disrupting some very old traditional industries in ways in which we just haven't seen, and I feel like it's been starting quite a bit at the microcap level. I don't know if you guys have been seeing the same thing.
I'm unmuting. Yeah, the model, it's kind of interesting because when you stick around and say it's SaaS-y, okay, well, as I said in the early introduction, you're really looking at a recurring revenue model, and the projection of those recurring continuous streams of income makes it very attractive to an investor because it's almost predictable. Okay, the other part of this SaaS, it's not SaaS, but it's recurring revenue, is in disposables. Okay, so there are a number of medical device companies, for example, that offer any number of different devices that what they have is they cannot be sterilized. They have to be thrown away. So you sell somebody an underlying foundation or a platform or a box, a technology box, and what you do is you plug something into it. And every time you plug something into it, that becomes a disposable. So there are these models. I mean, so
razor blade. I mean, that's
a razor blade model. Perfectly, exactly what it is. There's a company that I know that they sell filters. Okay, they sell filters into blood machines, and they throw them away. So the more. So it's all about, in that case, it's all about the number of machines that you install, the number of indications that it can be used for, and the number of hospitals it has. So again, it's just at this point in time, it's a numbers game. You increase your numbers, you increase your sales. Thank you very much, and it's almost somewhat predictable because what you can go into in the medical side of it is you can go in and sit down and say, okay, how many of these indications are attended to each year? An indication being a disease or how many people have cancer, how many people have diabetes. That's an indication, whether brain or blood or whatever. But some devices have multiple indications. So again, you can look at those things and say, wow, that's a recurring revenue model, okay? And that has to be looked at as well in the same kind of thing.
I mean, would you guys say that, well, it's funny. One thing that I forgot to mention to you before we got into that part is, I've even found myself in some of the interviews that I do with management teams that we post on the YouTube channel is, I'll ask, is there a recurring aspect to your business model? It's like you almost have to ask that question. And companies now, I feel like almost feel like they have to have some sort of recurring aspect to their businesses, whether it's SaaS or not. Razor blade SaaS, I mean, look, and to their defense, I mean, as investors, that's something that we want to see, right? You want to be able to try and predict what their revenue might be, in the coming year or quarter. But I had an interesting question for you guys. I mean, do you think this SaaS model, the moat, is closing, or how is SaaS evolving in a way? Because it seems like it's closing in this idea of just so many success stories that started off as freemium models, right? Where you get the freemium and then you upsell them on some kind of subscription service. What do you guys think? By the way, Kelvin's about to join in. Here we go.
That's
Maybe
great.
I'll re-ask. I'll re-ask the question for Kelvin. We'll throw him right into the fire.
Yeah, go ahead and do that.
All right. What's up, Kelvin?
Hey guys.
Hey.
Nice to see you guys.
All right. By the way, this is Kelvin Seetoh at Slingshot Capital. He's joining. We're very appreciative every time he does join us early mornings because it's late nights in Singapore. So, Kelvin, thanks for joining us, man.
Hope I'm not missing too much.
We're
from Steven and Kevin.
Oh, Kelvin, we're about to throw you right into the fire. So I'm gonna re-ask this question going right to you. So,
Awesome.
we were talking, we're talking SaaS today. We're getting sassy as usual, a little sassy here. And, I asked the question to Steven and Kevin here is that, do you feel that the moat's closing a little bit for SaaS? How is this idea of this business model growing? Because, you're starting to see the freemium model where you get something for free and then you're upsold something to then subscribe. And a lot of successful companies are doing it like that. So what are you seeing right now, and how does this model really evolve?
Yeah, I think I would say that SaaS is one of the most customer-centric model that you ever seen as a business model. Like whoever gives free stuff, before you even pay, right? You get to use the product even before you pay a single cent. And I think, for example, right, if it's a SaaS company, in terms of the cloud architecture, I think it's way better than anything that I've ever seen, in terms of the business model. For example, if you look at Symantec, which is obviously not a SaaS business, whenever the updates that is being given, it has to be patched subsequently, and sometimes the patches takes a long time. But as opposed to look at the new generation, the cloud native competitor, which is CrowdStrike, right? Whenever there's a new patch that's being done, it actually automated. The updates are automatically updated behind the scenes. And I think it actually keeps all of them well protected. So I really like the cloud approach. And also I think about, if you look at Zoom, right, there are a lot of users who are on the free side of the business. They don't even pay. You look at Cloudflare as well. providing a CDN free as well. So I think at the end of the day, if you look at a cloud business, because the fact that it has very high operating leverage, the cost to kind of provide an additional service to additional user is actually very low, which is why they're actually able to thrive to do really well on the freemium side. And only if people really feel that, they have utilized the free side, they saw the value in there, they said that they saw that how the operations have been improved, then that's where the trust is being earned from the customer side. And subsequently, when you kind of like sell them an additional software, they see the value in that and they pay and they don't mind paying. And I think the best in class SaaS companies, they tend to have very low churn rates. And precisely why? Because the customers are already convinced that this is a great product. Even they pay us before even they're paying a single dollar. So, at the end of the day, if they want more features and they are asked to pay, why not, right? They would absolutely love to pay for that.
It's fascinating because what Kelvin just described is really the B2C model. We were talking about the B2B model. I think it's pretty cool that, as he said, that the freemium portion of the B2C has been, I think it might be fading, but you can talk about that later on, Kelvin. Excuse me. But the freemium part has had some value contribution to increasing the subscriber base. The interesting thing about it is that that freemium model has been discussed in B2B and it fails miserably. Okay. The other part about it is that the B2B side, look at the moat, Bobby, you're asking about moats. I think the B2B side is there for a while at least. I don't think the moat's closing in any fashion. And the reason why is because the way in which the model is presented to the company is shifting the company, the purchaser model from a CapEx type of deal to an OpEx type of deal. And I think that's big from the standpoint of company monetary management. So again, I think that there's strong evidence to suggest that the companies really want to have the payment model altered. Okay. But again, going back to what Kelvin says, the B2B is far different from the B2C.
Well, what's interesting on that point is when you think about the value prop, and Kevin, you mentioned Salesforce earlier on this panel, and one thing I've used Salesforce in the past, and one thing that I really noticed and I loved about Salesforce, full disclosure, I'm not a shareholder, but it seemed to have that user experience that you would want if it were just B2C. It has that user interface that's very, it takes a second, but once you kind of figure it out relatively quickly, because it's very clear how each things work and what this is, accounts and blah, blah, blah. It has that feeling that you want if it's a software that you'd want to be using, for in that B2C type model. What do you guys think about that? Because for the most part, it seems like a lot of the B2B user interfaces or that are trying to have this SaaS model for their businesses are not as B2C friendly as they probably could be. And then I think ultimately would help them win, or win more business. So I don't know. What do you guys think about that?
Yeah. And that usability is much different now than it was, say, 10, 12 years ago, because our work life and personal life, those lines have totally blurred. If you remember 10 years ago or so, 12 years ago, when the iPhone started gaining prominence actually in the business community, remember at the time when you were at work, you had your BlackBerry. And they said, you don't want to use your personal cell phone. You are not allowed to use your personal cell phone for work-related things. And so people at work had a BlackBerry. People had their, iPhone at home. And what is that like today? Right? Obviously, there's no BlackBerries. It's very rare that people are using BlackBerries, but also people have one phone typically now. And they do a lot of work-related things on that phone. Now, of course, working from home, the boundaries are totally gone. And so with that blurriness, though, it actually leads to, I think, more usability, the incentives for more usability on the business side. Because if you're getting interfaces that are easy to use and other things like that are more personal in nature, you're going to start demanding that through some of the business applications. And I think you see that with Salesforce and other CRM tools. And now there's even some like bookkeeping tools and things like that on the business side that have become much easier to use and much more, kind of the interface is more personal in nature. And there'll be more and more of that. And if you see, I mean, this is why like Robinhood, for example, just as an example on the brokerage side, has gained so much prominence because its usability is so easy that any idiot 18-year-old can use it, right? And there are applications that are taken from that will be used or will be applied more to more institutional trading interfaces as well. And that's probably a good thing long term.
You bring up a really interesting, it's so funny. I literally had just gotten an email on how literally SEC charged Robinhood Financial with misleading customers about revenue sources and failing to satisfy duty of best execution. I mean, they're going to be ordered to pay a huge fine. But what's interesting there, and for all the faults that Robinhood has, but using them as an example here, is that when you are kind of at the forefront of creating a new user experience that can be very disruptive, whether it's because the model is freemium versus just a breakthrough new experience, there's these types of potentials here, right? Where you have to think about the consumer depending on what that service you're going to be providing and making sure that, I mean, it's impossible to forecast every possible thing that could happen or how your platform could be used and abused. But at the same time, there's this sense of responsibility too when you create some of these platforms as well, and how you respond to that. So I mean, it sounds hopefully they make some adjustments based on that. But Stephen, you were going to say,
yeah, absolutely. And I mean, but to that point though, some things, the usability can be gamed in a way to generate more revenue, right? And to make engagement easier. And I'll give kind of a personal to business example, just the online portals for banks, right? So we have your personal bank, Bank America, Chase, et cetera. Very easy. Bill pay is very easy. Everything is set up very easily. And then on the other hand, on the business side, both for my fund that I run and also the public company, when you log into those interfaces, we're stuck 20 years ago. And it's very difficult to, why can't we make an online wire transfer request, for example, very easily, like you can do in your personal account, you can't do in the business account. That's kind of the next generation, I think, of usability that basically, we're going to start demanding on the business side because we've been using it on the personal side. And you want that ease of use, and the business company, whether it's a bank, corporate accounts for banks, or whether it's other examples, they're the ones who are going to come out as winners over time that make it just as easy to use on the business side as on the personal side. And, how that relates to valuations and SaaS related things. I think, look, this is why Stripe is so successful. This is probably why Snow, which we talked about earlier, but we don't know exactly what they do, is a success. This is why Square became successful.
Yeah. I would support that 100%. I mean, I've been in the game for quite some time. And one of the things that is clearly a driver for success in particularly any software application is ease of use. I mean, the word has changed, usability, but it's always been ease of use. If you made it so that it was easy to use, you would kill the competition. If the existing product was a little bit more clunky or whatever you want to say. So I think that's at the basis of the marketing of these types of tools. And I don't think that marketing is different whether it's SaaS or anything else. If you make it easy, people will use it. I think the one thing that's happening is, I think that there is if you want to use a globalization, not the right word, but a globalization around the general design model. And I think you said it correctly, it is coming from successful consumer-based products because the businesses are incorporating the consumer type interfaces, the consumer type addresses and things of that type within their products. So I think you're absolutely right on that. So I would support 100% the fact that make it easy to use, and that's 90% of it. I think there was studies done, like 70% of the decision making is brought on by ease of use. Again, particularly on these crappy legacy systems.
Yeah, and when you think about valuations, right, and the story that's being told, and how do you determine the stickiness of these customers, I mean, these are very esoteric and qualitatively based judgments and decisions. And that's why I think you get so much of this variability of valuations of various businesses, even whether it's B2B or B2C, same thing, that it's really difficult to judge long-term, eventual kind of cash flow generation from some of these businesses.
Well, I think it's probably reasonable to expect that, if we're going to just look at churn rates, if we want to analyze that real quick, if we're looking at B2B, I think you would say the average churn rate for a successful SaaS company is probably low, right? Because there's probably high integration costs and getting everything started up, so if they're going to move from one service to another, most businesses just have to think about, all right, well, what's my cost to now move everything? Versus with B2C, you kind of expect, all right, I guess it depends industry to industry on how high that churn rate could be, right? Because it's relatively easy to, I'm not going to use Netflix anymore. I'm going to use this, or, well, I mean, in my case, I'm a entertainment, I consume everything. So that's probably a bad example, but and I'm not a shareholder in Netflix, but you know what I'm trying to say there. So, I mean, Kelvin, can you give us maybe a little bit of just based on your experience from what you've seen, I mean, what's some average churn rates when you're looking at B2B and also B2C, for what investors can look for as an average, or what they can expect a good company on both sides to have?
Yeah, I think the focus has been, I think before I want to talk about that, I also think about, I'm a big believer of actually software, because, if you look at a business in itself, you kind of like outsource the difficult part about running certain difficult operations, right? For example, you don't spend a capex, you don't spend a servers, you don't kind of maintain an engineering team. I think in the past, we kind of priced it based on per license, per seat kind of arrangement. But increasingly, what I've seen that have worked out really well to kind of align in terms of the customers and also the software provider is actually usage-based pricing. I think that's something that Snowflake is using. That's something that I also believe Fastly is using as well. So I think back to the question, in terms of the churn rate, I think you're totally right. There's some companies that have higher churn rates, there's some companies that have lower churn rates, the B2B to B2C kind of nature. But I think to kind of like reframe that question, I think we kind of have to look at the dollar-based retention rate instead, right? So there's churn inclusive of the expansion spending from the cohort of the spending. Because sometimes if you look at churn, I think that could, there are some areas where maybe the product doesn't have a strong product market fit, or because certain companies, they go bankrupt, that's why they kind of like cancel the subscription. But they also within the same cohort, the same customers that have acquired for their single year have a great expansion, right? It means they kind of spend additional money. For example, I spend probably like $500,000, but right now I spend like $700,000. So to me, what is something that is really good, I think, is a dollar-based retention of more than 125%. I think that's a bare minimum. So that's something that I actually look at a lot. So as I think when Kelvin and Stephen was sharing their stuff, I also was thinking a little bit about B2B, right? Because the freemium model, I really believe that it doesn't work very well for B2B, because B2B their requirements are much higher. And in fact, even though it's a software delivering to the product, but they still want certain customizability. For example, if you look at Fastly, even though you use their software, but you still need developers to kind of do configuration to give you that full range of customizability. But for Cloudflare, the solutions are much simpler. But I also think back about, if you look at the biggest market caps around in US, right? If you look at maybe like Apple, Microsoft, Amazon, I do feel that while B2B business is a bit more sticky, but if you look at the best markets out there, right? The companies that have the largest market caps, it just seemed to me that most of them are B2C, right? It still represent one of the biggest market over there. So I think while it's more enterprise customers are more sticky, but I think it also should cater to all the small, medium businesses, because those are really the backbone of the economy, and it could represent a lot of opportunity if they do not target those sectors. Yeah, but again, I think I would not just look at churn, but I look at dollar-based retention rate more than 125%.
Yeah, that's not saying that different models. If you wanted to go in and talk about churn rates, it's kind of funny because they kind of flip backwards. They call a positive churn rate is when you lose subscribers. Okay, and if you have subscribers and the number starts to get into 5, 6, 7% of churn, you're starting to look bad. If you go over 10%, you're really in trouble. The other thing that's quite fascinating is it's called negative churn. When you add customers or you leverage or you're able to expand upon what it is. So that there are ways in B2B in which you gain a customer and then you basically expand from there, okay? In B2C, you typically don't expand because the person's using it over and over and over again. It's the upsell, if you want to use that. You can upsell in the B2B, and I'm not quite sure, Kelvin, you may know better, but I don't know that well, is whether or not there's any much upsell going on in that area. Now, the other thing that Kelvin mentioned, and he's absolutely on the money, is that we talk about a moat, and one of the moats that's one of the factors in SaaS model moat security is the fact that the corporations have also modeled a new approach to IT. As he said, that they're getting rid of all of these services and the like onto the cloud. So what used to be a very traditional model for an IT department, which is hardware-based, is now becoming software service-based, and that's also going outsourcing. So the corporate models are shifting to either respond to or drive these types of things that benefit them. Again, this outsourcing has been going on forever and ever and ever. I mean, the simplest thing you can look at is some of these big companies used to have cafeterias. Okay, they used to run them themselves. This again a long time ago, and they outsourced those, and it became more and more and more an approach where you outsource things that aren't core competencies. IT is now being considered to be not a core competency any longer because it's being overwhelmed by all kinds of different value deliverers. So there are these fundamental characteristics of corporate management that are changing, and they are creating this stable moat for a long time. However, as I've mentioned in the past on these moat conversations, I think moats are indefensible over the long term, and because of time and innovation. But again, I think Kelvin hit on the mark on some of the fundamental aspects of why these things work. And again, churn is. But he also mentioned the fact that you look at the total cost, what the impact is on. We talked earlier about acquisition costs, Kelvin, and the loss of customers, and you know, if it cost you $260 to acquire the customer, but you only extracted $180 from the person before he left, then you're in trouble. Yeah, so it's the idea of how long is the value how long is the value to the customer, how long does the value exist to the customer that the customer sees and chooses to participate in. And again, it's a value proposition that has to be maintained over the time.
And Kevin, I would argue that I think the upsell for the B2C, I think that model is definitely something that's been in place, even if they're already subscribed to it. You know, I think it's just also probably company to company, just looking at the economics. You know, you look at like a Disney Plus, you know, full disclosure, not a shareholder in Disney, but, you know, you're seeing them, but that might be just symptomatic of the, you know, movie theaters. It's impossible to go see any of their theatrical releases. So they just say, hey, subscribers, you pay an extra $30, you get to see a brand new release before it comes out. But ultimately that could probably be a loss leader because, you know, you guys know the cost of productions and it's very, very expensive. But maybe over the long term, as that gets adopted more, you know, that might actually end up becoming economic. Right. But I think it also, like I said, I think it's company dependent, you know, based on different kind of features that you have that you can quickly create or not, or roll out, or, you know, all that kind of stuff. So I definitely think there's a lot of value to upselling even paying subscribers. It's just, you have to provide something that, you know, at the very least your customer has, and your subscribers have said specifically, we want this, you know, so you know that you can at least model out like, all right, if we roll this out, we know we're probably going to get at least 20% retention on this new feature that we're going to roll out.
I mean, all about marketing. I mean, ultimately upsell is all about marketing, and the basic summary is listen to your customers. I mean, that's that's the first rule in business: listen to your customers and respond to their requests. Okay, rather than trying to cram something down their throats that you think that they want, and it's the likelihood of it failing is pretty high. So again, it's one of those things where upselling is driven almost exclusively, in my opinion, by the fact that the customers are demanding something more.
Yeah, and I just want to add that I think if you look at software in itself, it's no longer looking at this as a one-time transaction, but there's this book by Tianzhou. This book called Subscribe. It says that it's now a relationship, right? How do you ensure that relationship remains strong, right? It's just like having a wife. You got to make sure that she has her needs being met. So it's just like having a users, right? What are their needs that's being met as well? And so I do look at the best of class software companies. They usually have a marketplace, right? For example, if you talk about Salesforce, I don't own Salesforce, but I own CrowdStrike, or even you look at PAR Technology, they do have their own unique marketplace whereby, they do have partners, right? They do have developers that are actually developing APIs to actually enhance the features of the core software in itself. So as someone subscribes to the software, maybe they need an additional utility, additional features, they can go to the software marketplace to actually add on some sort of like a plugin. And over time, you build your whole business around it, right? Your operations around it. And for you to kind of like unsubscribe, it creates so much disruption, and that's not really good. So I believe it's one of the most stickiest business I've ever seen. But again, I think if they stop giving updates, it's very apparent that the business would end. The relationship would end. So I think that's where churn would appear. So it really forces a business to be really customer centric, and that's what I really love about software businesses. It's a relationship.
It's a very interesting piece of information that I found out when I was doing all this research. I was looking at the Salesforce, already noted that I don't own it. One of the things about Salesforce is it's something like $22 billion business right now. And they have, as you noted, they have tons of partners and others. The one note that I can make was that, and I was just shocked, is that the amount of money that's made by management consultants servicing Salesforce and Salesforce companies is 3x revenue of the 22 million that is generated from just Salesforce alone. So the management consultants are making $66 billion providing services to hangers on about these things. I was just like, oh, you got to be this. So again, it's a platform, and because it's corporate, again, the whole value chain goes up, and it becomes quite fascinating, quite revealing.
I mean, how cool, how amazing is it to create a business where you now can put on your resume, Salesforce expert? Like that's the business we need to create, where like people are using that as, that's a resume, and it's totally legit. Like you want somebody to come in and be a Salesforce expert, not because it's hard to use necessarily, but because it's a lot to manage there, especially if you're a bigger business.
I'm a COBOL expert.
You're a COBOL.
COBOL programmers are making a shitload of money right now.
Yeah, because
they all look like me.
There's a huge shortage of COBOL programmers, and they are being paid really highly. So congrats.
Kevin's side job. It's his side hustle. But since we're talking about this, I think we should touch on Microsoft and the transition really for quite a few of Microsoft's services from one-time sales to recurring revenue, especially on when you think about the Microsoft Office side. I'd be interested in hearing Kelvin and Kevin's take on that, and how how risky was that at that time of transition, and what does it look like going forward?
Good question.
Well, I must sit down and say I was going to write a Twitter feed that basically said, "What the hell does Microsoft do these days?" Seriously. I'll transition to Kelvin, but I think that I know that they're doing this Azure software, and that's basically in the cloud, and so again
Xbox. Kevin, come on, man, get with the times. They own Xbox. Yeah, exactly. There we go. Kelvin, can you help Kevin out here?
What did they do?
Kevin, I do think they have a lot of things that's going on in the business right now. You have the commercial Office 365 commercial, you have LinkedIn, you have Dynamics, you have Azure. and they are making a comeback really strongly in the laptops area, Surface, search advertising. So I think Stephen put out a great point, right? Like, how do you know whether, what gave Microsoft that courage to kind of did that transition, right? If I pay one time versus now I'm actually paying a subscription revenue. But the way I look at it, maybe I draw my experience from some of my friends who are working for the GovTech, that means Singapore's government technology agency. Actually, Microsoft, if you look since the start of personal computing, it kind of coincided, like Microsoft was born out of that era. And since those times up to today, I think most of our documents are either processed in Excel, Word, or PowerPoint. Although I know there's OpenOffice, which is a like free software kind of thing. But you look at the amount of documents that's created around the world, all of them are mostly created with an extension that belongs to Microsoft Office. So, and you would never want to, is this kind of thing is it's called a cognitive reference, and also it's like everyone is using it. The network effects are just so strong. And today, if you just create maybe a file that is maybe end off with craft, right, and you send to someone, no one can open that file at all. And either way, I think the ecosystem is so strong. It's just the fact that all of documents since computing has started has always been with Microsoft 365 extension, and people just cannot do without Office. It becomes a utility in our daily lives, right? If you think about, we have a broadband, we have our electricity, computing software, the basic, we have our operating system, which is Apple, you have Windows, but to do work, we just need Office 365. So I think with that understanding, I think it wasn't a risky move of theirs. In fact, I think it's a very timely thing that they should have done a long time ago. Yeah. So really the mode of the product is really good, and it's so distributed worldwide. In fact, even if you look at China, come on, they're still using Office 365 after so many donkey years, right? It really shows that the strength of that software, and it's just really a utility in itself.
Yeah, but is Microsoft a SaaS company? Going back to the original comment of this business of this podcast.
I mean, they own so many different businesses, like, I mean, on their LinkedIn business, I would argue it's a SaaS. I mean, the Xbox is more of razor blade to a degree because you have to buy the box, but then, you can buy all the extra services. So, I mean, and then on the Microsoft Office side, like that would be a SaaS model, right? Like I have to pay a subscription every year to get Microsoft 360, so that I have that on my computer. And I wish they went back to the one-time purchase.
Yeah, because we're spending more money now, right? And look, I had that before, and that's the whole idea. And that's when you look back, there was not that, there really wasn't that much risk when you look back. And to Kelvin's point, because of the necessity for the average person to have to subscribe, but at the time, it seemed to be a very risky proposition. In hindsight, not as much. And it seemed to be risky because you say, well, look, I have my, when I got it on the CD or whatever, and I uploaded my Microsoft Office 2008 or whatever it was, or 2010, I probably wouldn't need it until I got a new computer, or if I lost that CD and the code and everything like that, or until the accessibility went away when the next generation came out. And how much did that cost? $100 in 2010? I'm spending $120 a year now just for basic functionality.
I mean, look at AppleCare, right? AppleCare, they used to, whenever you go and buy a computer, you'd have to, they give you the CD. Here's your CD, upload AppleCare, or you pay that extra bit each time. Now it's just software and you pay the same price. I mean, it's the amazing part about software.
From a corporate perspective, the broader corporate perspective is that Microsoft apparently has chosen to generate even more revenue based upon what Kelvin said, the fact that it's a foundational application. And people cannot go away from it. Like you said, it's electricity. They can't just shut it off. So if it's foundational, let's call it monopolistic if you really want to look at it that way. There are no other spreadsheets that are out there. There's no, there are, but I couldn't even name them.
Hey, I tried for a business school project. I tried to make an argument that Google Sheets was just as good for doing financial metrics as Excel, and I wasn't laughed out of the classroom, but I made it a compelling argument. There was some basic functionality.
But it's still a spreadsheet. I mean, fundamentally,
still a spreadsheet.
Doesn't make a damn
That's
difference.
true. It does. You can do some.
And as you know, the functionality that you use in that tool is extremely modest. It's like 5% of what the functionality is. Again, we're getting off topic, but again, it's kind of an interesting conversation. But again, is Microsoft a SaaS company?
I think I don't know. I get my answer on it. I think it's yes and no, because they have so many different.
Well, but I think that's where you saw the valuation go up so much over the last 5 years, right? I think it's run up dramatically. And why is that? Why was that? And it's because major parts of their business turned into SaaS companies. Whether you define Microsoft as a whole as a SaaS company, I think is a little bit irrelevant. It's more of their major business lines that generate the majority of their revenue collectively are SaaS companies, and they transitioned into it over the last 5 or 6 years, and that's why the stock price has gone through the roof during that time period.
I would argue that Microsoft, did they have the balls to change, or did they take the big risk to change and all that stuff? They may look at, on the other side, is that they were probably being hammered on by various companies, because they are in every large company in the universe. Okay, they have huge connections everywhere. They got major amounts of information and research being done, and again, they have customers telling them what to do. And if they may have not chosen to respond quickly enough or whatever. But again, I will argue that the reason why they changed was because they were looking forward at going down the tank. Okay, again, I'm being a little bit more broadly based here, but they saw the handwriting on the wall, and they almost had to change. I don't think they were disrupting their own business. I think that they were probably kicking and screaming to do it because they had so much control over what was going on. Again, Kelvin said, it's foundational, and you can't.
Well, when you think about a transition to software for that, I mean, you have some major corporations that are now going to have to create subscriptions. I mean, you have to now think about all the investments you have to make in security. I mean, I'm sure, Kevin, to a degree, I bet you're right, is there was kicking and screaming because they were probably looking at the risk management side, like, oh, shit. Like, we're going to have to spend millions, potentially billions right now just to make sure that our potential customer base, our existing customer base, feels secure, and now switching to a subscription model. And that's across the board, I'm sure.
It's probably the biggest decision that many companies are into right now is the choice. It wraps around the IT discussion as well. It's the choice of do we or do we not? Now, how do we do this move from legacy to SaaS? The U.S. government has pretty much basically said we're not doing SaaS. Okay, so and they're one of the biggest influences of revenue in many places. Large companies, they do it. They do it. Help me with the word here, Kelvin. It's the in rep, but they do it in house. Okay, they want the computer inside of their firewall, but they'll put your software on it. Okay, rather than buying it off the street, coming down the wire. So there was all kinds of these issues that people just not wanting to leave legacy yet. Okay, and wholesale into using a connection over the cloud to access what proprietary information. So there's a lot of stuff that's going on that is fundamentally changing in the IT business. So then there's quite a bit of fear related to what could happen if the data is out there, in the cloud and someone else can access it. So there's a tremendous amount of issues about why you don't want to go to SaaS. Okay, so those are that's the other side of it. And that's one of the reasons why it takes some companies kicking and again, I use the word kicking and screaming to get in there because they don't want to. So there's a split mode in B2B. There's oftentimes these splits between either getting it directly off the cloud or having a customer base, having the customer host the software that you provide on their own internal operation. Kelvin, it's a word in it. Maybe you know what the word means.
I think I just add on. I do not know everything, but from Singapore's perspective, recently we had a fintech event, and we'll talk a little bit about cloud as well. So I think a lot of our services, while it's on-prem, but I guess it's slowly shifting to cloud. I think cloud is something that is really hard for us to reject because the value that's providing is just way more than inconvenience. For example, you talk about on-prem, you need to have like engineers on site to solve the issue. You cannot do it off-site. You have to be on-site, and in terms of agility, that's actually a bit restricted. And I think all of us are probably aware that Azure won the contract from Pentagon to do actually a private cloud. I started to see adoptions coming on already. I mean, in Singapore, the government sector is like, hey, cloud used to be a word that, don't speak about it at all, because there's going to be risks. If things on the cloud, it's going to be exposed to hackers here and there. But now, we are having this private cloud thing, and also having a hybrid. But I guess over time, things will move over to the cloud fully. There's this program from the US. It's called a FedRAMP. It's called Federal Risk and Authorization Management Program. There are some Salesforce is on the program. I think Zoom is on the program. Datadog is on the program. It really shows that the government have actually created a program to certify certain software companies to be safe to be used on government services. So I do think that the change is going to happen, or has already happened.
The other part that's basically resisting SaaS is the fact that many companies see it, whether good or bad, depending upon how you look at it, is it affects employees and the number of employees that you have. The outsourcing, of course, takes much of your IT department and dismisses them. There's a company that we track where they're doing these oil and gas businesses, where they have analysts working to review data that predominantly is on Excel. These new apps are putting them on cloud-based environments in AI, and as a result, these analysts' jobs are going away. So again, there are both corporate internal HR issues with regard to personnel management and things of that side, and individuals who have a fear that their job is going to be replaced. So again, if you look at selling some of these things, selling from a legacy to a SaaS solution, you have constraints or barriers that are in the way related to dealing with people. Okay, so again, those are some of the reasons why the SaaS model is a bit feared in some cases, and is getting a lot of pushback.
I think I just want to add a quick comment on that, and also like the way how software is that this is the only thing that they do. So I think for software companies, this is really the core competency. But let's say if you have your own team, how can you claim that your own team is competent when they're just doing work for you, as opposed to having a software core team that is providing a software service and getting feedback from thousands and hundreds of customers. So I believe that actually when we do outsource it to someone, a software developer who has core competency in that area, we actually get a better outcome and a better product to kind of service us a lot better. So I really think that it may sound a bit not caring, but I think that the world will move on, and we just have to evolve and just find ways to make ourselves more useful, regardless in whatever jobs that we are in. Because would we rather stay with the kind of solutions that we have, or we think that there's a better solution out there and we should adopt it and move forward along with the time? So that's just my 2 cents in that.
So I wanted to close out this panel today because I look, this is going to be part 1 of, 50 when we're talking about SaaS and valuing SaaS. But all right, this should be fun here. So let's say we wanted to create a SaaS-based company, and we're about to IPO tomorrow, and we want to get the fattest valuation we possibly can. We could be pre-revenue, revenue generate. That doesn't matter to me at this point, But we want a fat valuation, post IPO, right? So, what would be the most ideal SaaS company that we could create? And we don't have to say specifically what sector. If we want, we could go like, all right, it's a SaaS model in niche, business. And I guess we could get fun with that. But that, I guess I'm just already getting started there. But, what would you guys say is the ideal SaaS business model and the particular sector to get the fattest valuation we can?
Well, financial services, right? But I don't know. This is SaaS adjacent, but there was an interesting article about OnlyFans a couple of days ago that I read, and I think that's a recurring revenue. I don't know if we want to call it software, depending on how things are delivered. but to go outside of even kind of the pornography area or erotica, or like the OnlyFans, these fan subscription models, and that recurring revenue could be massive, incredible. And the story that could be told to that is where you get those valuations. But if you want to go a little adjacent to that, in the financial services area, and if you're taking a cut of every transaction that's being made, there's some vertical integration potential there as well to any sort of subscription model. And if you can vertically integrate in that way and tell the story about how then you'll take over the world in the next 10 years, then there is just no valuation that, the highest number could be justified in any way, even if it's pre-revenue.
If I wanted to generate a ridiculously high valuation for a company at this time, it would probably be something where if I breathed on my phone, it would tell me whether or not I had an infection. Okay, that's today. I mean, I don't think that the valuation is long lasting, but it has the opportunity to be global. It has the opportunity to be based upon a fear, which is always great to sell on, and something of that type. So again, and it's COVID and it's related. But again, if it's today, that's where I'd go. I mean, I don't really care about what's going to happen to my valuation a year from now, because the company is all about making money by selling my stock.
Yeah, I guess kind of Steven hit the nail. I'm particularly very enthusiastic about financial companies at yen. You look at Stripe, you look at the valuations they're commanding is high because you're addressing a global market. So that's really a huge thing. I think sometimes in terms of health, I may have a differing view on that because you only take care of your health when shit happens, right? When shit doesn't happen, you just go around eating all your fast food. So people may not feel compelled to kind of pay that subscription. And fear do sells to some people, but if you have not experienced it, it doesn't like kind of sells to me. So but I think financial is something really interesting. So I'm thinking along the lines of a SaaS business that's serving there's on the financial side.
So Steven, it sounds like Kelvin has become a Stripe acolyte.
Well, look, I mean, I that's what I said. If I had one investment I could make in the next 10 years and hold it for 10, 20 years, I'd pick Stripe if you have access to it. And look, I don't buy things at the IPO very often, but I would buy Stripe immediately and just tuck it away and let it and hold it.
All right, I think we're there, gents. That was some good answers. It sounds like collectively we have a 2-to-1 advantage on financial services B2C SaaS company versus a health tech. I think you'd want it to be a B2C SaaS company, but you know what? I'm going to ask that on Twitter too and see what everybody else says, so that maybe we can come up with create a collective for one company just based on a crowdsourced information, and then maybe Kevin can develop it, using what'd you say? It's COBOL? Yeah, with COBOL. Or I've never even heard of that, honestly, until today.
Well, the thing, Bobby, we've got a business idea that Kevin introduced here. What would maybe create a Twitter poll? What valuation would you put on that idea if it were to be public today? Let's say pre-revenue. This is like a Nikola situation, right? It reverse merged into a SPAC and became public. And this is the idea, and it was proven to work. And it's going to be rolled out in the next 3 months. What sort of valuation do you get on that in 3 or 4 months from now when it starts creating revenue?
Just run up and down Sandhill Ave and just shout out and see what the answers come back as.
Wait, no, Kevin, you know what? We're going to have to teach Kevin how to create a poll so that he can do it. That'll get him above the 500 for sure.
Hey, I've already got the poll. Today's poll was, is shorting part of your trading strategy?
Oh, how many votes
that's engaging.
Do we have?
That's engaging.
I only have 500, less than 500. So you have to have. If I had 12,000, it'd be far more interesting.
That's an engaging question, though. I like that, Kevin. That's a good one.
So the other question that I had was, what is your investment strategy? Do you trade according to a plan? Do you trade according to your gut? Do you trade because the stockbroker tells you what to do, or do you trade because a Twitter guru tells you to do something? Okay. The best reply was 0 stockbrokers. Okay. But the other part was that 50% of them were I trade my gut.
I can't tell you how many stockbroker numbers I've blocked in like the last 3 years. Yeah. It's insane, and they still find my numbers somehow. You know, like, oh man, so many pitches. But anyway, okay. Anyways, guys, let's wrap it up. Give everybody where they can go and find more information on you and to follow you. So, Kevin, the Good Prick at the Good Prick.
I'm still at the Good Prick, and I actually, because of you two guys, not necessarily Kelvin, because he hasn't been punching on me, I've become very engaged, and I am surging in the number of people that I have following me now. And as I mentioned to you two guys, I've already got my red Speedo already set up, and I'm practicing.
Yeah, look at that. There it is. There it is.
Did you download TikTok? Is that so? Have you actually downloaded TikTok?
No, I just looked at the Jack Black thing on YouTube.
But no, you can find me at Steven_Kiel on Twitter. Happy to engage.
All right, Kelvin.
All right, so you can find me at Slingshot Cap. Yeah, just Slingshot Cap on Twitter.
Very cool. All right, guys. Well, thank you so much for joining me today. That was really awesome. Stay safe. Good luck. And I look forward to our next panel where we talk about SaaS for the next 4 weeks. Take care, guys.
Thanks, Bobby.